Always available, but some things don't change. I'm delighted to welcome you all here this morning to Property Finance Forum's second annual joint event with the Association of Property Bankers. So welcome to all members from both organisations. This morning's theme is retailers, retail. First of all, Stuart Morley, who's Director and Head of Research at GVA Grimley. He's been Head of Research there since 1989 and apparently has 40 years experience in the profession. Stuart is responsible for the firm's bulletins, analysing economic and property market trends, producing regular 5-year rental growth, capital value and investment return forecasts. He regularly speaks at conferences, some of you may have heard him speak before, and is author of many articles, textbooks on valuation, development appraisal and economic and property market forecasting. So Stuart's first up, and then we'll be followed by Jonny Hewlett from Diesel, who's the Managing Director of Diesel. Jonny joined Diesel in 2008 after 16 years at Procter & Gamble. He had many roles within the P&G group. He was responsible in the fine fragrances division, brands including Hugo Boss, Dolce & Gabbana, Gucci and Lacoste. His interests include French culture, skiing and endurance sports. And last up, to bring us home, is Nick Deeks, who is Director of International Real Estate at Costco Wholesale. Nick's first job was at Jones Lang Woodman, as it was then, and he worked mostly in the retail team. He particularly worked on at the time, new concept of factory outlet shopping and warehouse clubs. And he was poached by Costco and became the property director a few years later. He was promoted to the position director of international real estate 4 years ago, where he's responsible for all their retail, or rather real estate matters outside North America.
So different retail sectors, fairly similar in the downturn, as you can see. The only point I would just make there is the blue line, which is retail warehousing, the out-of-town sector. Throughout that 20-year period, has shown much stronger rental growth than the in-town sector. In the left-hand part of the chart, that's really due because it was an emerging sector, lack of supply, strong demand. And then in the middle of that, the chart more to do with planning controls limiting the growth of out-of-town retailing. Not terribly successfully, but it has limited the amount of development, and that's in real terms, stripping out inflation, and you can see not actually moving back into positive above inflation territory until after 2014, but improving around then. But I think the strange thing about that chart, well, initially strange, which you'll never have noticed, is the similarity in all those lines over this period. Rental growth has followed retail sales growth, consumer expenditure growth, and economic growth over this period here. And then gradually, in particular over this period, a huge divergence, pretty weak rental growth and very strong retail sales growth. And you would think that the two would be directly correlated. My explanation for that is largely the internet. The internet has improved competition, and bricks and mortar retailers have had to lower prices very competitively. And obviously it's siphoned off an increasing amount of expenditure from the physical retail. It's a pretty similar outlook, but slightly stronger for retail warehousing for the reasons that I talked about before. But an improving trend, just so that I don't leave you with a negative outlook. I mean, it is going to be an improving trend, but not dramatic, and not as dramatic as it was after the last recession, as you can see there. On the investment side, looking at yields very briefly, I've got two charts which show very that one shows the level of equivalent yields, or property yields, relative to two long-term averages, and you can see quite marked fall in yields, particularly at the prime end of the spectrum. I should really emphasise it, I don't think I emphasise. There is a huge difference between poor secondary and tertiary retail investments, or any type of investments, and prime investments. This is an average of the two, but with an emphasis more at the prime end of the market. That fall in yields that's happened over the last 15 months or so has very much been at the prime end of the market. Longer leases, good covenants, and strong locations at the weaker end of the market, secondary investments, there hasn't been really any fall, hardly any fall in yields at all. It shows that fall in property yields over the last 15 months, but the gap between, say, long-dated gilts has widened, and is very wide historically. If you look back to a more normal period there, you expect property yields to be higher than gilt yields. I won't go into all the details for that, but that is a very large positive yield gap, so that leads some people to argue there's still a long way to go with property yields falling to narrow that gap to a more normal. It's too pessimistic, I would say, but hopefully the two following speakers won't completely disagree with what I've said. So thank you very much.
First of all, I haven't got any charts. I have 3 numbers, not including the slides. But I really want to try and give you an overview of what fashion retailers anyway, are thinking when it comes to retail property and how I see the trends in terms of the reason for having retail stores changing over the minutes. Finally, as retailers kind of lay out an offer. Seasonal fashion retailers such as ourselves used to have 2 seasons a year. We used to bring out our autumn-winter collection around about the middle of July, and that would run through until the end of December. And then, just as the sales were ending, we bring out our spring-summer collection. So, kind of twice a year, we would put on our offering, our clothing offering to the consumer. That's prehistoric now. The need to constantly drive freshness in terms of the layout of our product is cyclical to the point of every 3 or 4 weeks. There needs to be something new installed. If you're going to be in brand temple, is it a statement from a brand? Will it be a lifestyle lab? Or will it constantly provide a new message to the consumer every time we visit? We know, and picking up on Stuart's point earlier about primary locations and secondary locations, there are locations in the country that are immune to the sort of pressures of the economy, etc. However, for all others, the flexibility will be key for any new space. An interesting space will increase in attraction, as I said, as brand statements need to become more and more differentiated. So I hope that's given you a useful insight into fashion retailing. I'm now going to pass over to Nick, who will talk about Costco. Thank you.
I'm going to start by telling you what is a Costco. Well, they look like that on the outside. And in the last 5 years, they've been voted in the US as one of the top 50 most admired companies. And inside, they look like that. Big warehouse, we call them warehouse, not stores. And they have non-food stuff sold in racking from pallets down the right-hand side of the building, and down the left, we sell food. And in the middle, the government that seems to be making life a little easier for us at the moment. Certainly across the board, we're seeing fewer called-in planning applications. Our requirement, here's the plug, we want 104 square foot building to about 10 acres, looking for about 1 million people in a 30-minute drive time. And as I said, we don't take risks. We're good at selling mayonnaise, we think, but we don't choose. My boss tells me, which is a bit of a worry, we're not very good at real estate. Leases, sorry to say this, but we don't particularly like them. We'd rather own our property. We don't like the fact, we took some 20-year leases in Korea. We're already worrying about how we're going to replace those properties in 2018. We don't particularly like the inflexibility that comes with leases. But we've worked with a couple of landlords. We've got 2 leases in the UK now, where I think we've managed to deal with most of those worries. The only thing we won't do is make
to all of our speakers this morning for that.